Okay, hi there. My name is Echela Okori. I'm your finance and accounts coach. This morning, I want to share with you the meaning of the phrase fair value. Fair value. This is a phrase that every accountant should be familiar with. If you're an accountant and you don't know the meaning of fair value, or you cannot explain it clearly to the understanding of a market woman, then it means you don't really know your onions. So also, as a user of financial information, as someone who gets financial statements to make decisions, you also should know the meaning of fair value. Now, when we say fair value, what do we mean? Fair value simply refers to the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Now, this is the IFRS definition. That is the International Financial Reporting Standards definition, which is issued by the IASB. That's the International Accounting Standards Board. So, let me break down this definition, what it means. We'll say the price to sell an asset. Now, when you want to sell an asset, everybody knows that an asset to be sold, you must get paid for it. It could be cash, it could be something else of value, but there is a price to receive to sell an asset. Also, if you want to transfer a liability, you have to pay to transfer a liability. Nobody is going to accept a liability from you if you're not paying that person. So it might also be cash, and it could be also something else that has value. So whether it's an asset that is being sold or a liability that is being transferred, it is between market participants, and it is an orderly transaction. It has to be an orderly transaction before it is fair value. So it also, the definition ends with at the measurement date. So there has to be a date. There has to be a date. Then let's talk about the orderly transaction. What does it mean? Orderly transaction means that you have willing participants in that market. That's buyer and seller. They are willing. Nobody is forcing them. It is an orderly transaction. It has rules and regulations, and nobody is flouting those rules. You understand? In fact, in a previous definition, the standard made use of the phrase, what is it again? Not orderly transaction. It's arm's length. Yes, arm's length transaction. So what we mean by arm's length transaction? It means they are not related parties. I don't know you necessarily, and you don't know me. It is not a dealing between husband and wife where there will be considerations, where the price is not really determined by market forces. You have sentiment when you are selling this. That means you are not doing it at arm's length. So this orderly transaction has to be at arm's length. It has to be orderly. And then most importantly, there has to be the measurement date. Measurement date means that fair value is not constant. It is dynamic. It keeps changing. Fair value of an asset or a liability today might be different from tomorrow. It may change. So there's always a measurement date. It may not be that drastic between today and tomorrow, but basically, periodically, the market value changes. So the fair value cannot be the same. So basically, we say it is a price received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date. This is fair value. So anywhere you see fair value, this is the meaning of fair value. And it's a very, very important concept in accounting, especially in the use of the International Financial Reporting Standard, which Nigeria as a country has adopted and has been using for a long time. All right. If you enjoy this episode of the finance and accounting coaching sessions, keep a date with me. Tomorrow, I'll bring you another one. Thank you.